What's up, everybody, and welcome to another episode of Sand Hill Road, the show where I talk to successful startup founders and their investors about the companies that they built and invest in. And the goal, like always, is to give you a sense of what it's like to be in their shoes, to understand how their businesses tick, how they got to where they are today, and to learn from their many successes and mistakes along the way. And today I'm super excited to be joined by Brandon Wales from e.ventures.
Thank you for having me.
At e.ventures, Brandon invests in consumer internet and enterprise software companies. He has co-led the firm's investments in companies such as Segment, Acorns, Shipped, House Call Pro, and most recently, Airvet. So Brandon has been really fortunate to be part of a number of rocket ships during his tenure at e.ventures. But like many VCs, he's also had his misses. And earlier this year, Brandon published this really legendary Medium post where he detailed how he and his team passed on the Series A of a company you might have heard of, TikTok, or Musical.ly as it was known at the time. And while other venture firms in the past, such as Bessemer, have published their anti-portfolio, so the companies that they've passed on, Brandon has taken it to the next level here, giving us really full-blown detail on his decision-making process on TikTok. And in this session, I have this really unique opportunity to double-click on his thought process at the time and to understand how passing on TikTok has really shaped him as a venture investor. But I would say let's hear it from Brandon himself, and let's jump right in. All right. Welcome, everybody, to another episode of Sand Hill Road. I'm joined today by Brandon Wales from e.ventures. So welcome, Brandon. You ready to take it from the top?
I am. Thank you for having me.
Wonderful. So before we dig in, let me go back to your roots and let's start with your first job. During college, you ran a golf shop. For many people who have this perception of venture, a couple of golf buddies might be the perfect place to start with venture.
Yeah, for sure. So I grew up a golfer, a competitive golfer, went to the University of Georgia, and a logical place for me to try to work was, of course, the university golf shop. And look, I mean, it's a great place as a college kid, right? You get free golf. And you get to be around the thing you're most passionate about, which is important. You know, I think the thing I learned the most is, hiring for people that are excited to come to work every day and provide that incredible customer experience to those who come to the golf course. Golf is a very competitive business. There's a lot of options out there, and if they come to the course and they don't have that great experience, there's no reason for them to come back. So that's the number one thing in the golf business. And I think about that today as a venture capitalist. There's a lot of competition. Every single interaction we have with an entrepreneur needs to be absolutely perfect, from the way we schedule our meetings to how we follow up every single bit of the way. So, it's definitely had an impression on me.
And then next steps after you graduated?
Let's see. I studied finance and graduated in 2009. So it was probably the worst time in a long time to be looking for a job. And fortunately, I did get a job, and it was for a large financial service business called Sun Life Financial. It's based in Canada, publicly traded, Fortune 500. And it was in sales. And, I was living in Atlanta. I was working this sales job, and it was great. I mean, I learned how to kind of run a sales process, how to prospect, all the good stuff. And there's a lot of benefit from working at a large company. But at the same time, I had always been in love with entrepreneurship and starting businesses. Actually, while I was at the University of Georgia, I had tried to start a location-based technology company. That was in 2008. And then in 2009, when I was working at Sun Life, I actually built a website called Starving Freelancers, which was a marketplace for booking photographers and videographers. And no one was doing it at the time. And I built it with a friend of mine from high school. We built this beautiful app. And then we realized, wait a second, how do you actually build the business from here? How do you get the supply? How do you get the demand? I didn't know anything. And in Atlanta at the time, there was very little consumer internet expertise, right? And so I said to myself, well, how do I get that if I want to be an entrepreneur one day? I was like, I got to go to the Valley. And so for about 2 weeks, I just went onto Crunchbase and I looked for companies that had raised Series A financings. And I found this business called Zozi, which had built a marketplace for booking outdoor activities. And I cold emailed the CEO. And then 2 weeks later, I was living in San Francisco as the 10th employee of a venture-backed startup called Zozi.
Wow, what an incredible turn of events. What was it like to be at Zozi's? They just raised their Series A. In a perfect world, you would have companies increasing their headcount incrementally,
Yeah.
but oftentimes it peaks around the raise. So you were
Yeah.
probably part of a cohort of new hires.
Yeah.
What was it like?
First off, I got unbelievably lucky because I moved to San Francisco in 2010, and timing is really important. So I joined this business. I was the 10th employee. I was really the first kind of full-time person only to do sales for the business. And my job was to call on small businesses and get them to be a part of our platform. And I mean, it was wild. We went from 10 to 65 employees in 8 or 9 months, and then raised a Series B, so it was kind of 7 months after I had joined. I mean, it's wild. Everything breaks, when you're growing that quickly. You start figuring out who the right cultural fits are. What are the needs that you really, have to tackle that you don't or you miss out on. And most of the time people overhire, which we did. And so there had to be layoffs. And we went through 2 rounds of that. And there's constantly people shifting between different roles. I ended up in a completely different role. And so it was sort of everything you'd want in a job, although it didn't become a unicorn. So that was the only thing that I missed out on. But I've got that true startup experience that everyone hopes for.
And then in 2012, you decided you had enough operator experience and you decided to move into the investor role. How did this transition happen initially?
Yeah, so I had moved to San Francisco because I wanted to be an entrepreneur one day, and I was 25. I was working at Zozi. I had all this experience, and I ultimately wanted to scratch that itch and start a business, but I didn't have enough money to do it. And I was like, well, what's the best way for me to save up some cash and also learn the other side of the business? Because I'm going to need to raise venture capital if I start a company. And I did the exact same thing I did to get my job at Zozi. So I started cold emailing GPs at venture capital firms. This was in the fall of 2011. I would send them a deck of companies that I liked, congratulate them on a recent exit, and got a few interviews that way. And messed those up and didn't do a great job, but I learned sort of what I needed to do. And then I found a job posting on the Crunchbase job board for e.ventures, and they were looking for an analyst. And I cold emailed everybody on the team, and actually the executive assistant found my email, my cold email, then sent it to an associate who then emailed me and said, hey, we should chat. That actually went to my spam folder. I then randomly was in my spam folder looking for something else, saw that, and then 14 days later, I was employed at e.ventures. So it was a crazy kind of turn of events. I could be in a lot of different spaces right now.
It's also an exception to even have job postings in venture, right? And I think given the heritage of e.ventures as a German corporate VC firm, they still feel like they should give everyone the chance. Let me double click exactly on this and let's talk a little bit about the history of e.ventures. It came out of Bertelsmann and it has now really graduated to be a top seed Series A firm in the US. Maybe talk to us a little bit about the history and what the firm is like today.
Yeah, for sure. So the firm was started in 1998 by my partners Tom Gieselman, Matthias Schilling, and then Jan Buttner and Wolfgang Rose, who were a part of Bertelsmann before. All of them worked there, and they helped build AOL Europe, which was eventually sold to AOL Time Warner. Upon that transaction, Bertelsmann gave them money to start their first fund, which was called Bertelsmann Ventures. And so they started the firm in 1998. The first vintage was in 99. They raised a second vintage in 2000 and went through all of the challenges that come with that. And frankly, I mean, I couldn't have gotten luckier to join this group. By the time I joined in 2001, they had gone through really two, devastating recessions and had managed continually to have incredible performance. And so, I joined a firm when I was 25 with two guys who were both 39 years old, who have been doing this their entire lives, who were still incredibly motivated to build a big platform, which is needed for a younger person, right? If you're not kind of expanding the pool of capital, if you're not, building different strategies, it's very hard for a young person. And so that's why, I've been able to rise with the group and grow with them. As it relates to, our strategy, at the end of the day, we're looking to invest in businesses that build products that people love and enjoy. And the reason why those companies are growing really quickly or have great sales and marketing efficiency is because of that affinity for the product, right? And so whether it's a consumer internet business or an open source software tool, doesn't matter, right? We spend a whole lot of time trying to understand why that demand is there. We've got a bunch of unique ways to do that for proprietary software to find those businesses as well as evaluate them. But at the end of the day, we're looking for consumer demand and following that.
The fund that you're currently investing out of, you raised 400 million together with the European fund, so 175 million for the European fund, I think, then 225 million for the US dedicated fund. And I saw that you also have a Brazilian and Tokyo office. So the firm is really one of the few ones with a global footprint. Talk to us a little bit how that works in terms of team coordination, deal flow.
Yeah. For sure. So we have independent teams and funds in each of those regions. So here in San Francisco, Germany, which covers all of Europe, Sao Paulo, which is all South America, and then in Tokyo and Japan, which covers, or Tokyo and Beijing, which covers all of Asia. And we believe in local decision making. We think that the team in the U.S. is going to have a really hard time making a decision on a German consumer internet business. And so we want to have experts in those regions, and for everybody to be managing those businesses by themselves. But we do manage a global growth fund here in San Francisco, and everybody on the team around the world is a part of that and helping to drive those investment opportunities. And so we sort of centralize that knowledge here and then deploy capital in sort of Series B, Series C opportunities with our growth fund here in San Francisco.
Very nice. So let's talk about one of the great rocket ships you've been part of, which is Segment. The Segment story, it's a fascinating story. So I remember back, I think it was even in 2015 already, that I heard Peter Reinhardt, when he was still a few years out of Y Combinator, on how they pivoted early on.
What did you apply to YC with?
We actually applied as a classroom lecture tool. So the idea was to give students this button to push to say, I'm confused.
To put their early version on GitHub and then productize that.
We're like, okay, we have 100K left in the bank. What's our final shot? And my co-founder Ian is like, you know what? I think there's a big business behind Analytics.js, which is this routing library. And I was like, that is literally the worst idea I've ever heard.
E.ventures has really been on this journey since the seed round, I believe. And now the company has raised, last round was a 175 million round. In total, almost 300 million. Talk to us how it was to witness this growth. It must have been an amazing experience for you.
Yeah, it's been great. Let's see, the business actually was sent to us by the CTO of one of our portfolio companies, this guy, Conrad Chu, who now works at E.ventures. He built all of our technology in-house. And he sent us, myself and Tom Gieselman, an email in 2013 and said, hey, you may want to check out segment.io, which is what it was kind of went by at the time. And he made an introduction to Peter, the CEO. There were 4 co-founders. And all it was this open source piece of software called analytics.js. And what it allowed you to do was to pump data from basically one marketing tool to another with a flip of a switch. And so if you're using Kissmetrics and you wanted to go use Mixpanel or any other analytics tool, you could just flip a switch. You didn't have to retag anything. It was instant. And we knew from our portfolio companies how much of an issue this was. And at the time, it was really taking off. They had I don't know. They had like 1,000 installs or users of analytics.js within like 2 or 3 months of it going live. And so, we were introduced to Peter. We sat down with him, and we knew instantly that we wanted to invest. I mean, Peter's an exceptional entrepreneur and really had a good understanding of the problem in the market. And so I think we did, they did have a couple enterprise customers. The Knot was one of them, and those folks were willing to talk to us. And then 2 days later, we issued a term sheet for a $2 million round on an 8 pre. We put in $1 million, and Kleiner Perkins put in $1 million. And then from there, the business started to scale really nicely. They went from 0 to $1 million in ARR in a year. And then they went from 1 to 5, and then 5 to 20, and from there onward. And so it's always had great product market fit. It's always been something that entrepreneurs have always wanted to use, and so it's been a great ride.
You had a quick turnaround of 2 days. Fast forward a similar deal. Would you expect it to be more competitive? Was it really the proprietary sourcing that gave you the edge here?
I think it's just generally our philosophy around investing and following demand. And I'd say we were really early on in understanding that developer tools and sort of light infrastructure, those businesses are, at the end of the day, are just like consumer internet businesses. There's an individual within a company who makes the decision to use a product because it's affordable or it's open source. And we had a lot of learnings because we were the first investors in Nginx, the world's most popular web server, which was acquired by F5 recently. We're the first investors in that business. And we had been in that company for about 2 years, and we had realized, oh my gosh, if there's all this demand for the product, you can layer on a ton of different monetization components in order to scale the business. And so when Segment came in and we knew that the market was really huge and it was solving a really big problem, then it was instant. And we still act that way today, right? I mean, we are always moving within days typically and verifying some data and then moving forward, whether it's B2B or B2C.
Given that you're normally more consumer focused and Segment being a highly technical team, also a technical solution, but it has, of course, a market in the marketing departments of consumer companies. Would you say that this angle gave you an edge there?
Yeah, and it was sent to us by the CTO of a consumer internet business. He started a business called Munchery, and so he knew the problem very well, right? And when it was sent to us, and so but all of our portfolio companies were having the same problem, and so that helps you move forward. I'd say like we don't like to do investments in B2B if we don't have a really good understanding of kind of that end user, right? And so I'd say like top-down enterprise sales is not the perfect thing for us. Like we really want to invest in this sort of affinity towards those individual decision makers. And so we always love doing open source software. We still do, and we just think about it like it's a consumer internet business. And we're looking at the cohorts, we're looking at the virality, all that stuff.
So let's talk about consumer internet, and let's talk about one of the big misses in your career. And you published this legendary post where you describe how you passed on Musical.ly's, now known as TikTok, a 10 million Series A at a 100 million valuation. And so it all started on Monday, July the 6th, 2015, when Thomas sent you this email. Have we talked with Musical.ly?
Tom sent me that email. I was actually on the East Coast because it was July 4th, and I was sitting in the airport, and I got that email, and I was like, okay, well, if it's growing really quickly, we want to talk to them and try to understand it before making any decisions. And at the same time, Dubsmash was also growing really quickly. I don't know if you remember that business. I think it's still doing very well, actually. Pretty similar to Musical.ly, although there were concerns around music IP rights. And so our concern initially was, is this just a utility where people create these videos, they layer on, a popular song, and then they post it on Instagram and get a lot of likes. And then people see the TikTok logo on the bottom, and then they go use TikTok, and then they repost it on Instagram. But none of that feedback of likes and hearts, so all that stuff was happening on Instagram, not on TikTok, when you really want it on, or Musical.ly at the time, right? And you just want it on your Musical.ly app, and that's how you build a real consumer product. And so that was our initial concern. There were a bunch of video sharing apps in 2012, or Justin Kahn had one of them that was growing really fast. And so our concerns were that they got that initial growth, it was just a utility, but they don't build their own community. And so that was our initial concern with the business.
And Thomas actually provided a print screen from App Annie. So he screened or identified this growth hike in Musical.ly through App Annie. And I remember this German documentary with Matthias Schilling, where it was in your San Francisco offices and going through different App Annie charts basically to identify who he wants to talk to. So you yourself, it is described on the website that you're closely involved with the firm's development and utilization of in-house technology to do early metric-based discovery. A number of VCs say they always want warm introductions with Segment. This was the classical case. But I always respected the way in which e.ventures is using this data-driven approach. Talk to us a little bit about how you use that on an everyday basis.
So my partner, Tom, about 10 years ago, after investing for 12 years, he came to the conclusion that whenever he'd meet companies, he wanted to get to the slide where he saw the chart going up into the right, because that says, how much consumer demand there is, whether it be a B2B or B2C company. And so he said, well, how can I find what's on the internet that's already out there? He calls it digital exhaust, to show which of the companies around the world are growing the most quickly, and then I'll go talk to them. He hired an engineer, and he built the original product in 2010. And after kind of revving on it, he then realized he needed resources to call those companies. And I was that person, the first full-time person to call, based nothing besides on data-driven sourcing. And he had an incredible insight, and it's something I'm really focused on today with our younger folks, which is, if all you do every day is talk to the fastest-growing companies in the world, you start to understand really what it is that makes those things run. if your bar every day is incredibly high, and it's not just about, me thinking that a sector is interesting or me thinking that a person could build a big company. It's about, no, this is working and this is working incredibly well. And every company I speak with is doing great. And so it then creates a bar that is remarkably high. And so, just as you're sort of the average of the 5 people that you spend most of your time with, I think like your investment performance is just, the average of the companies you speak with. And so for me and for our team, like there is an incredibly high bar for getting on the phone with a company. We want to feel like it's doing well already. We want to feel like we have a good understanding of the market and we can act on it when we meet the business. And so, not every one of our companies is going to be sourced through technology, but in one way or the other, we're prioritizing our prospects for follow-up. We use technology to help make investment decisions. We've automated a lot of the cohorting and benchmarking that people do manually, all of that to help us have sort of a mental model of what the fastest-growing companies in the world look like. And we think if we do that really well with really tight systems and processes, then we're going to make, great 7 to 8 great new investments every year in the United States.
Back to Musicali.
Yeah.
So you identified this opportunity. You reach out to the founder, and it's still the right timing. He's in the process of raising the A. You come back to him with a number of metric requests to basically get a better understanding of the business. Talk to us a little bit about the metrics that you requested there: daily installs, daily users. What are these key metrics that you look for in a consumer social company?
So, the list I shared is, exhaustive. There's 20 things I was asking for. The number one thing I look for in a consumer app is time spent in app and sessions per day per daily active user. For a teenager, it's probably 5 to 8 hours a day on their phone. They're going to spend 2 hours on Instagram, an hour on TikTok now, an hour on Messenger. And the question is, how much of that can you get? Right. And if you can't get their mind share, you're never going to. And so you need to have a pretty good understanding of, what is the benchmark? Is this an app where people use it for 30 seconds a day, or is an app that they could use it for, 40 minutes a day? That was the primary thing that we were focused on. Now, the problem at the time was that, although we could get the benchmarking data from App Annie, the sample size for Musical.ly was pretty small. And so the time spent in the app was pretty low at the time, maybe a tenth of the big social apps. So that was something we were wrestling with. This thing didn't have the session frequency or time that we typically look for. But at the same time, it was the fastest growing app in the world, adding 350,000 installs a day. And there's value there. The growth is first, and then second, how much depth, how much time can you really get from a person's day? I don't want to invest in an app where, people just go in to check the weather. It's not going to be valuable enough. Right.
Yeah, I remember the founder talking about how he thought about building it, and he had this Machiavellian notion of Musicali, that he wants to create a new country. And when you create a new country, you need to have new citizens basically join that country, and you need them to really want to stay there and spend their time there. And he thought really like the art of war style about how to get people engaged and basically get them to stay there.
In the early stage, building a community from scratch is like you just discovered a new land. You give it a name, America. And you want to build economy, you want to build population, and you want people from Europe to migrate to your country, right? And Instagram is Europe. Facebook is Europe. How can you do it? Economy in Europe is already very developed. And in your country, there is no population, there is not so many things going on, there is no economy. How can you attract those people to come in? The problem with Europe is the social class is already stabilized. For average citizen, they have almost zero opportunity to go up in the social class, right? So now you have a new land. A very important thing is, in the beginning, you have to build a centralized economy, meaning that from wealth distribution point of view, you make sure majority of the wealth is distributed to a small percent of people to make sure these people get rich first, okay? And then these people became role model for other people living in Europe And they see, hey, this is a normal guy, and he just went to America and he became super rich. I can do the same, right? And then lots of people came to your country, and then you grow population, you grow economy.
So after some negotiations, you ended up passing on Musical.ly, something that I assume still haunts you to this day. Maybe not. Maybe it's just left the right scar tissue on you to not miss out on the next one. Talk to us also a little bit how you think about this. I mean,
yeah, for sure. So, it's disappointing. The company was sold for $1 billion, so it's not like it would have returned the fund because we were getting at 100 million posts potentially. But now it is a part of ByteDance, and it became TikTok. So it's it would have been nice to be a part of that and claim that we helped grow it. What we had done after we had done this pretty thorough analysis around engagement, the one thing we were really concerned about was is this something because it's grown so fast. Is there enough stickiness? Was it a slow burn into becoming something really big like a Facebook or a Snapchat had? Or is this something that just pops up to the top and drops back down? You've seen that in trivia games and other things that had reached the top. We were investors in a trivia game that had done this. And so our thought was, is there enough at the ground in order to sustain the business? Is there enough content or whatever in order to get people to come back? And so what we did is we ran an analysis of every single app that had ever grown as quickly as Musical.ly had. None of them had ever continued to stay, within the top 10, where basically all of the enterprise value accrues within social networking and messaging. And so that was a pretty important factor. We thought that, it was probably unlikely for them to maintain their position at the top. And so we passed. It was a big mistake. And as I highlighted in this blog post, we're looking for the greatest outliers on the planet. Comparing something to the past, it's really not the right way to think about things. And so when we are looking at consumer internet opportunities, we really we take the learnings from the past from a product perspective and maybe some KPIs, but we really try to focus in on sort of what is the thing that people love about this? Is it a big enough market? And then make the decision. We're not going to overanalyze because that's what we did in that circumstance.
Yeah, for sure. One really notorious funding round of this summer was Clubhouse, which had very similar terms. I think it was a 10 million, also a 100 million post. Founders took out, I think, $1 million in secondary each. Clubhouse, so as far as I understand, had about 600 or 1,000 users in private beta. Given the experience you had with Musical.ly, how do you think about something like Clubhouse?
It's really more about sort of the portfolio construction at the end of the day, right? And how we think about it is, let's say you're going to construct a portfolio of 30 companies. I think the most simple way to think about it is you need every single one of those opportunities to have the ability to return the fund, either one times or multiple times over. And if you do that and you construct a portfolio where you have 30 real shots at that, right? So that doesn't mean it means you can't take any any shots where you're worried about the TAM, right? And so you need things that can really be, have asymmetric upside, right? And so first off, Clubhouse checks that box. And so at 100 million posts, the question is, can a big social networking app be worth $20, $30 billion? The question is, yes, absolutely. It could be much bigger, right? And so for those investors, I didn't take a look at Clubhouse. For those investors who are thinking, okay, we found something where people are madly in love. They're spending a huge amount of time. It appears that content creators want to spend time in there as well. If you can get the content creators, it's clear that you kind of bring in other participants. Well, what is the market size for people listening to audio content and engaging with content creators? Well, it's enormous, right? It's absolutely massive. And so to me, it's a good investment. And the price doesn't really matter that much. I mean, you look at Meritech's investment in Facebook at 400 or 500 million. That thing has been incredible for them, and so it was the right thinking, I think, for those investors.
I wasn't surprised to see Andreessen Horowitz lead this round, given that they've been in the past extremely bullish on voice, on how underpriced voice has been, especially like podcasting. But obviously they've written a large check. It reminds me of the GitHub round where everybody was like, wow, now you really have to bring that one home. I'm sure it's going to be a lot of work, but definitely an interesting financing round. So let's move on to another great post of yours, which was a bit more technical. So we all know that in venture you really have to optimize for the upside, and that you have a few fund returners in the end, and most of them return 1x or 30% or write-offs. And you created this great chart of the archetypes of the early portfolio performance, where you have, I think, 7 types. There's this flat return of capital, there's the early loss, there's the early markup. What have been your learnings in terms of dedicating your bandwidth? Do you focus it on the ones with a steady growth, the early losses where you try to recover them on the early stage side? You can get into this rabbit hole of trying to recover your losers. How do you think about that?
Look, we were always talking to the companies, right? Like, we are partnering with these entrepreneurs at the Series A, whether it's going well or it's going great. I speak to them the same amount of time, right? I'd say the ones that are doing really well, sometimes they can require more work. Most of the time they're not. They're sort of going, they're building, and there's more work around like fundraising and all that stuff. But time gets spent on things that aren't going well when you have to restructure, clean up the cap table and all that good stuff. But the one thing that I have learned and why I wanted to write that post is, now having been doing this for 8.5 years and having joined a fund about 6 months in, you start to see how the fund performance, is getting impacted by the individual movers. And what I do know is that, this fund, our 2011 fund, which is doing really great, 2 of like the top 5 drivers in 2014, 3 years in, they're not going to drive anything, for that fund, right? And then there were 2 companies that were completely they were going to go out of business, that pivoted, that are going to be massive drivers for the fund, right? And so you never want to give up on any one of these companies, and you also can't expect for things that are going really well for them to continue to go well. There's going to be this shifting, right? And it's also important around internally, right? Like, what is that communication like around individual portfolio performance? It's not about like who made that investment, because everyone knows that these things change a lot. There's a lot of variables. And so it comes back down to, okay, like, this is a patient business. There's going to be a lot of movement and shaking, and the things that maybe you didn't expect end up becoming the biggest drivers for the fund.
And
right.
so one thing that's often been criticized is that for the earlier managers, I mean, e.ventures is now an established firm, but for the earlier up-and-coming firms, oftentimes what you see at the seed stage is that they really back those companies, basically pattern match companies that are in an attractive vertical where they feel, okay, they can get to an early next round, an early markup. Because obviously, if you're establishing a new firm, you really want to get this early markup. How do you feel about this? Do you feel like being part of e.ventures, you have more patience?
Yeah. No, I got you. So how do we sort of think about things that get marked up quickly?
Exactly.
And, I mean, it happens all the time. I don't like anoint them a winner. It's great that they get marked up quickly. If it's from Sequoia or it's from somebody else, I don't really care that much. I mean, it could be nice. It could be helpful a little bit in recruiting, but at the same time, I'd rather invest more, right? If the company is doing well, I'd rather invest more with our growth fund and continue to support and back that entrepreneur. We have an independent thought on that business and the market. Whether somebody comes in and throws, an incredible price on it, I don't think it changes our perspective or excitement. And, even things that maybe aren't going as well as planned, the thesis is still there, and we're going to learn from that. And maybe the company's not operating as well as we had thought, but we don't think of them as losses initially, like early on, because we've seen things pivot, right, or change their trajectory. And then the things that get marked up doesn't mean they're going to be worth $5 billion one day. It just means they've got a markup and they got more cash on the balance sheet. That's really all, right? It's really the long, right? Can this business really become an institution in 8 to 10 years?
In the next section, I want to take a little deep dive into your weekly top of the week seed companies. And this is really an interesting read for everyone interested in understanding how professional investor thinks about deal flow. You always have these categories there. You start with the EVA growth index, then you go into the product, you look at different investors, total amount raised, business model, comparables. Then there's the X factor. Is this basically you rearranging your thought process every week, taking notes? How do we have to think about this schemata of yours?
I do this alongside my colleague, Nicholas. It's a fair amount of work, but it's work that we need to do anyways, right? To me, as a Series A investor, I want to know every single seed stage company, without a doubt. There's no reason why I shouldn't. And there's obviously a lengthy list that ends up populating the 5 companies that I highlight every week. But there's no reason why I shouldn't know them all. And so we spend the time and look at every single one of them and create this list of 5 companies that we should take a look at. But where this actually stemmed from was about last year in the summer. I said, I really want to work on just publishing things online. And one of the challenging things with creating content is it requires a significant amount of creativity, especially if it's long form. It takes a ton of time. When you get busy, you end up not doing it. And to me, I didn't want to start something where I felt like it wouldn't scale and wouldn't stick. And so the person that I think creates content the best online really in this market is Alex Clayton at Meritech, who does S1 breakdowns. And I was reading his content and I'm like, this is genius. Like, he has to do this work anyways. He takes the information from the S1 and makes it into a digestible format, and he publishes the content, and he gets tons of views by doing that. And so I said, well, what is this something that I need to do anyways, that I can just then publish it online and it's beneficial for me, right? Because I can share my thoughts, I can engage with those entrepreneurs, I can track them. And then, maybe one of those companies a year I invest in, it's well worth the time. And so it's worked out great. I think we've done, 50 of those posts in over the last year. We never miss a week, and I'm pleased with how it's worked out.
It's an incredible run, and I know as a content creator myself how difficult it is to carve out part of your job and basically say, this is something I'm going to put out in the world. But I love this. So let me double click a little bit on this EVA growth index, and then also on what are X factors for you.
Yeah. So the EVA growth index is a composite of a bunch of growth signals that we have internally, and it allows us to, it's kind of like the primary KPI for prioritizing investment opportunities for us. And so, for us, we think about the world as there's an infinite amount of companies for us to potentially invest in. And so how do you shrink that down into a digestible group of companies and then prioritize from there? And so when I'm looking at all of the seed companies, one thing that I really care about is obviously how much traction do they already have? And the EVA growth index is built around the things that we look for in consumer internet and kind of self-serve SaaS businesses or open source software businesses. And so it's built around that. And what it's looking for is how is an application doing in relation to its peers over a period of time? So if an app starts at a certain time period, how is it doing against everybody else that started in the time period? And it's basically, it does a really good job of presenting exponential growth. And that's actually what each change in color in that chart is actually a 10x in growth in relation to its peers. And so I think it's helpful to show to people, whether people know exactly what it is or not, it shows that there's a lot of traction. And so when I think about the X factors, it's changed a little bit over time. We're very much business model junkies here. We're always looking for things with incredible defensibility and high margin, but you can kind of get too focused on that. I do love, obviously, organic growth and EVA index is important, but the team really is the X factor at that stage. And so what I love to do is to look at who the founding team is, and when they've worked together in that specific category. That's amazing, right? Like, that's exactly what you want to do. You want to talk to those people regardless of their traction. And this is like, we're not even like, I'm not going to blog about companies that aren't tackling big markets. And then it's also nice when there's macro tailwinds, just like a big trend, like online mental health is a big trend. And, that's an X factor. It's important to have that timing, for a startup like that. And so those are the things we really focus on.
So let me pick one example from this week's post of yours, which is Nacelle, which is a headless e-commerce platform. And so for the listeners out there, headless web apps basically means that you decouple the front end from the back end. They've raised a seed, 4.8 million seed led by Index and Accomplice. Talk to us a little bit about that specific company and why you picked that one for this week.
Yeah. This headless CMS is for Shopify stores. And I know designing really slick interfaces for Shopify stores is a big problem. It's not easy to do. And so to have a framework where you can get a developer to build, or really kind of a web developer to build a beautiful application quickly, and as a result, driving the shop's performance through better conversion rates, there's just a huge market opportunity there. And as I've mentioned, there's major macro tailwind because you have e-commerce growth largely driven by COVID, even more than before. And no one's done this either. So it's like, you couple that with no one's done it, big market, incredible investors. It's like a kind of a slam dunk. That's one I got highlighted. I wish I had spoken to them. I'm not happy we didn't before the series, the seed round. And so hopefully we can track them for the series.
Yeah, I read that the founder actually had a like a boutique Shopify advisory business as well, where he basically had customers with exactly this problem, and then he could basically productize his advisory knowledge. So to wrap up this session, let me ask you about a recent public investment, Airvet, which is a telehealth veterinary clinic. On TechCrunch, there was a really cute picture of a dog. You participated in the 14 million Series A, which was just recently announced. Obviously also has huge COVID tailwinds, but talk to us a little bit about how you met them.
So with a lot of these things, an investment, it's not just from having that meeting and then discovering you like something. It's really from all the prior work from over the years and the companies you've met with and trying to figure out what are the models that really make sense. And so, Airvet is a mobile app where you can, with a push of a button, talk to a veterinarian on video or audio, usually within 10 to 20 seconds. And you can talk to both your own veterinarian if they're on the platform or another one. And it works 24/7 all around the United States. And, a lot of people are spending too much money going to emergency vet clinics because they don't know what's going on with their vet. And they fear that, there might be something really bad. And so they go there and they get charged $300 or $400. When in reality, most of the problems aren't major. And they just needed someone to talk to and get feedback from. And so, the market opportunity is fantastic. But the reason why we like this business actually is that Airvet itself doesn't do the customer acquisition. The customer acquisition is driven by the veterinarians. They bring their customers on, and those customers can access their vet, right, or anybody else if their vet's not available. And so, and the reason why we like that model actually is we looked at a company called Doxy.me, DOXY.me, about a year ago, which had built video collaboration software for doctors in a HIPAA-compliant manner. And we really liked the business. We didn't invest. We should have. We caught up with them in April, and we heard the numbers, and we're blown away. I mean, this company is absolutely massive. And we realized that's really the model. Like, we don't want to invest in a single app that's doing all the customer acquisition. We want a network of people doing the customer acquisition. And then about 2 weeks later, our associate Jaja popped up Airvet to us. And we moved really fast. We talked to them on a Friday afternoon, did a bunch of work over the weekend, had them present on a Monday, committed to them later that afternoon. And, one thing led to another, and it worked out where we could, get really meaningful allocation in the round, and closed, 2 weeks ago, and are happy to be doing it alongside Canvas. And Rebecca from Canvas, she actually has a farm, and so she's really close to the vet category. So we're really excited. I'm also a dog owner, so it's something near and dear to my heart. But it's a huge market opportunity. I have a miniature golden doodle.
Oh, wonderful.
He's 40 pounds.
So Brennan, thank you so much for taking all this time out of your day. Yeah. Where can people find out more about you and keep up to date with what you're doing?
Yeah, the best way to keep up with me is on Medium. So at Brendan Wales is the best place to find me. I publish every week with the top seed companies to track, as well as sort of random posts on just learnings from over the years doing this job. So please do follow me, and happy to also chat anytime if you reach out via email.
I can only recommend his writings. And thank you so much for tuning in this week. Thanks.
Thank you for having me.